Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company TD Bank. Now, they recently had earnings as of Thursday before open, and again, I know I'm a little bit late on this just like I was with Dell, but I figured, you know what guys, I think we could still analyze this company and even let's actually take a look at their earnings report too, just to see what we can find out if maybe we would like to buy this company at the current share price. So with that said guys, let's actually get started with this analysis. We are going to start off guys with analyzing a little bit of their earnings report. Now, full disclosure, TD Bank, it is the Toronto Dominion Bank, so every value here that you're going to see, it is in Canadian dollars. So I'm actually going to put you guys as well the Seeking Alpha's earnings tab just to see what it actually was, because we don't really see any percentages here, but nonetheless the numbers will be different. So we got the total revenue reported, and as of July 31st guys, it was at $10.9 billion, and well, 1 year ago it was actually at $10.7 billion. So that actually was a pretty good increase right there. As well as the total revenue adjusted, it was also up by an even bigger margin of 11.6 billion. Today, as of 1 year ago, it was at pretty much the same at $10.7 billion. So very good right there. Looking now at their net income reported, we can see that to date it is at 3.2 billion, whereas 1 year ago guys, it was actually at 3.5 billion. So this was actually a loss a little bit here, and when it came to this adjusted, we can see that it was a gain on the adjusted net income from 3.6 last year to 3.8 this year. So the net income reported was actually at 3.5 billion last year, and then it fell to 3.2 billion as of today, but the adjusted actually went up. So yeah, this is a little quick look when it comes to this. I will actually leave their investor relations site in the link in the description of this video, just so that way you guys can take a look at it if you so wish to do so. But let's actually take a look at this in Seeking Alpha. It is a little bit better, and that way we can see what the analysts were predicting. We can see here that the EPS, a normalized actual, was $1.62, which was a beat by 5 cents. However, when it came to their EPS gap actual, they made $1.35, which was actually a miss by 23 cents. However, the revenue was actually pretty good. They made $8.37 billion, which was a beat by $184.84 million. And as a result of that guys, well, their share price pretty much in the morning, which they did report in the morning, was up 1.15%, and by the end of the day it continued to be up another 1.86%. So the guys, they did really good, and you can see current share price of $66.61. Let's actually see if this may be a good price to buy it at using the book value ratio calculator. But before we do that, let's actually dive into this dividend, because they do pay out a dividend, and well, it's a bank, so banks are usually pretty good when it comes to paying out this dividend. And also, I believe TD Bank was one of those companies that several years ago they literally had zero debt. If I'm not mistaken, I don't know how much they have today, but I believe a couple of years ago they had zero debt, which is just mind-boggling. But nonetheless, guys, dividend summary, current dividend yield of, look at this, 4.16%. That is massive. This actually ends up being 69 cents per share for an annual payout of $2.74. Payout ratio, guys, is 40.88%, which is again really good. It's below my 60% cutoff, so I think they still might be able to cover it. Obviously, when it comes to banks, we really can't use discounted free cash flow, so this payout ratio that we got is the best that we got. 5-year CAGR on this dividend is also looking amazing at 9.31%. Dividend growth is actually at 7 consecutive years, so not too shabby either. Ex-dividend date passed as of July 7th, payout date was July 31st, and they pay their dividends quarterly. And now let us come over here guys to the book value ratio calculator. We got the ticker symbol of TD, market cap of $121.2 billion, PE guys of 10.73. So with the current share price again of $66.61, it's actually not looking too bad, guys. It really isn't. Now, obviously, when it comes to banks, as I said, we can't use discounted free cash flow. So we'll take a look at the book value and tangible book value ratios to see what the price should be based on their assets that they have in their balance sheet. So we'll get to that when we get to that. Looking at this annual dividends per share, however, we did see that it was $2.74, which in accordance to the shares outstanding, guys, this means that they pay out almost $5 billion in dividends every single year, which is massive. Now analyzing some of these fundamentals, starting of course with a net income of 5 years ago of $8.1 billion to today, guys, of $11.6 billion. Look at this increase of 43.63%. That is absolutely amazing. And what's even with that, guys, look at this, 5, 4, 3 years ago and 2 years ago, they were all increasing, believe it or not. Now from 3 years ago to 2 years ago, it wasn't that big of an increase, but it was an increase nonetheless. Even during COVID, this still was an increase. And massively from 2 years ago to 1 year ago, they went from almost 9 billion to, look at this, 11.5 billion. And even today, guys, this year isn't even over yet, and they're already up to $11.6 billion. So yeah, guys, they're pretty much just beating this net income into the dirt because they're just going up and up and up. Also, understand that inflation, guys, is rampant, not just here in the United States, but I'm pretty sure Canada's feeling it too. With inflation and with higher interest rates, I don't know what Canada's interest rate is, but with interest rates going higher, I'm going to say that they're probably going high as well too in Canada, just as they are in the United States. This actually does make banks better, believe it or not, because, well, they make more money from interest. Now, a lot less people could take on loans, right? A lot less people could take on loans, which could then essentially cut that increase from the interest rates. But nonetheless, assuming that they remain roughly the same, then, well, this actually does help banks out a lot. Looking now at the total revenue, we got 5 years ago of $26.3 billion to today, guys, of $34.4 billion. Now, this is not as rosy as the net income. 5 years ago to 3 years ago, pretty consistent increase. Unfortunately, 3 years ago to 2 years ago, this is where we see the COVID hit. They actually came down to $27.3 billion. But as of 1 year ago, guys, they brought it right back up, even surpassing the 3 years ago number to $34.7 billion. And as of today, they're only around $200 million shy from beating last year's number. So I think they'll be able to beat this fairly decently. Taking a look now at the shares outstanding, the metric that even when it comes to banks, guys, you still want this thing to be coming down, because a bank that pays out a dividend and they are actually issuing shares, that is no good. Absolutely is no good. Think about that. They're not just diluting you as the investor, but they're also making it harder for themselves to pay out that dividend, meaning that they'll probably end up cutting it regardless. So yeah, guys, you really want this thing to be coming down a significant amount. Now, when it comes to TD, 5 years ago, they did 1.8 billion shares to today, guys, 1.8 billion shares. Let's get a little bit more specific on this. 1.84 billion shares to 1.80 billion shares. Essentially, on the 5 year, guys, this is almost 2%. And from the previous year to the current year, it's looking at 1 year ago to 1.82 billion to today, as I said, of 1.80 billion. That is a decrease of almost 1%. Now, while this isn't a really aggressive decrease, it is a decrease nonetheless. However, though, I do have to point out something. They did issue shares a little bit here and there, especially during COVID. You can see from 3 years ago to 2 years ago, they went from 1.811 billion to 1.815 billion. And then from 2 years ago to 1 year ago, they increased it to 1.822 billion. So yeah, guys, it's unfortunate that they have increased it, but to be fair, they did buy it back today and it's currently around 22 million shares less. So it's actually fairly good. Looking now at the total assets minus the total liabilities, let us hope that their assets cover their liabilities. Now, from what I've noticed is that banks are usually pretty good with this. I think they're federally regulated to have this thing in the positive. I don't know if it's the same thing with Canada, and I don't even know if the United States that's even a rule. I do know that banks need to have a certain amount of collateral to cash on hand, to liquid cash on hand. So I don't necessarily know if that means this specifically, or if this even applies to Canada, but nonetheless, it is fairly interesting that pretty much every single bank has been in the positive when it comes to this. And well, as of today, guys, they're at $77.4 billion. And if you take a look at this graph, it is just beautifully increasing. This is what I call staircasing right over here. And by the looks of it, they might actually surpass last year's difference pretty soon as well. Average assets, guys, is around $1.2 trillion. Average liabilities is $1.1 trillion, and doing this difference, we get $69.2 billion. And now let's actually come over here to the valuation metrics, starting of course with the book value per share. The book value, guys, is essentially the assets that the company has on their books, and then we divide that by the numbers of shares outstanding to get this value. Now, currently, guys, this is at $40.83. 5 years ago, it was at $29.27, as an increase of 39%. Now, what most people actually find to be more accurate than that of the book value, it is the tangible book value. It pretty much takes everything that the book value does, except it removes everything that is non-tangible. And currently, this is at $32.66. 5 years ago, it was at $21.36. This is an increase of 53%. So what do these numbers actually tell us, guys? Well, we can actually do now the price divided by the current book value and the price divided by the current tangible book value. And essentially what we're looking for here is that we want this value, guys, to be as closest to 1 as possible. So you can see we are at 1.63 for the book value and 2.04 for the tangible book value. Unfortunately, this is telling me that it is overpriced at the current share price. In accordance, again, to their book values and tangible book values, this takes into account 0 assumption. Now, this is where you essentially want to make your own assessments. And I don't mean necessarily making assumptions. What I mean is okay, TD Bank, it is a bank that has been growing pretty good, right? I mean, they've been pretty much beating on their revenues. You can see right here, $184.84 million beat. They missed on their gap, but aside from that, guys, the stock price did rally today. And we can see by their fundamentals is that it's actually not too shabby, right? Essentially, everything is fairly good. So even though, guys, this is telling us that it is expensive, by the book value, it is 0.63 times overvalued, and by the tangible one, it's even more overvalued than that. Well, maybe you might be willing to pay this premium. I don't necessarily know. You know, when we do Citigroup, these values for Citi are like less than 1, to the point that I'm just like, this is a great value. When it comes to TD Bank, it's not. But if you believe that they'll grow into the future, at a 10 multiple or something like that, then you might be willing to pay this premium. Again, this is not financial advice, it never is. And because every investment is the present value of all future cash flow, guys, even if companies don't have any assumptions to be made, I still suggest that you take these calculators, discounted free cash flow, book value, revaluation, and even, guys, a dividend tracking sheet. I have all of this available for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment, really does help. We are more than 900 subscribers in to the 900 mark. I would love to get to 1,000 by the end of September. That would be insane. Oh my God. And at 1,000, I do plan on making a very special video. So if you guys want to see that, make sure you like, subscribe, comment. It's free. Thank you all so much. I really do appreciate it. Now let's actually entertain this dividend a little bit because, well, you can see right here, it is a pretty good dividend. So let's say that you make the average monthly income $5,725. If you're to put in 1 month's income into this company, which again, in accordance to the price divided by the book values, it is overpriced. But if you believe that they'll grow 10 times or 20 times into the future, then you might be willing to buy this now, believe it or not. So if you were to put in 1 month's income into this company at the current share price of, again, $66.61, this would get you 85.95 shares. And at the annual dividends per share, this actually ends up being $235.51. That's actually not too bad, guys. Quarterly dividends of $58.88 and a monthly dividend of $19.63. So you might be willing to buy this, guys, solely for their dividend. You know, $235, that's not too shabby. If we bring this to actually $2,000, let's actually see how much that would be. Yeah, that's essentially $82.27. That's not too shabby, guys. Imagine increasing your annual income by almost $100. That's not too bad. But again, it really just depends up to you. Their fundamentals aren't that bad, and their dividend isn't that bad either, and even their payout ratio is fairly good too. So it really just depends up to what you guys think this company will grow in the future. And by the looks of their fundamentals, they have been doing pretty good in the past. You can pretty much extrapolate that into the future as well. All in all, guys, when it comes to TD, it's a good company. I'm not gonna say it's not. Do I prefer other ones? Citigroup, yes, absolutely. In fact, I'm fairly certain if I were to do an analysis of, again, Citigroup, well, I probably think that it's still fairly undervalued. So yeah, when it comes to TD, yeah, it just depends up to you, right? I mean, it's not a bad company. Would I like it to fall a little bit? Yeah, maybe to like around like 50 bucks or so, 55 bucks. But it really just depends up to what your opinion is about it. that pretty much is it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Look at the description below. So with that said, peace out and be on the lookout for the next stock analysis video.